let's talk about corporations. A corporation is a legal entity that is completely separate and distinct from the owners. A corporation can be a publicly held company whose stock is actively traded on the open markets, or it can be a privately held corporation where only a few own stock, such as a family owns all the stock. In our area, a couple hours away, we have the Biltmore House, and the Biltmore House or the Biltmore Estate is a corporation, and all the shares, to my knowledge, is held by the family members. So that's a private corporation, but it is a corporation nonetheless. What makes a corporation different from other forms of business, such as a proprietorship and a partnership? Well, there's a few things. One is it is a legal entity. That's the first and foremost. It is completely separate from its owners. In other words, there's no pass-through taxation. The owners are not held liable for the debts. It is completely a separate legal entity. So since it is a legal entity, the owners have limited liability. A owner in a corporation cannot be held personally liable for the debts of the corporation. So when a corporation takes on debt, it is the debt of the corporation, not of the owners. Next thing is ownership transfer. The cool thing about a corporation is we can transfer ownership as easy as a blink of an eye. You can go on to your stock account and you can sell out of Walmart. So you can be an owner 1 minute and literally 5 minutes later you can transfer your ownership to a new member. So ownership transfer is very, very simple when it comes to a corporation. And that transfer in general, now there's always exceptions to this, but that transfer on a daily basis doesn't really impact the operations of the company. It can continue to grow and exist as is. The only time that changes is when that ownership transfer, you have a new majority owner, then that could impact your board of directors. Or you could have a takeover in that case. So it is possible for it to interrupt our normal operations, but for the most part, ownership transfer happens every day in the corporation, but the corporation never ceases to exist. It just continues. Now, another characteristic, though, is the earnings of a corporation may be double taxed. Now, double tax does not mean the corporation pays tax twice. It means the earnings of the corporation may end up being taxed twice. And how that happens is the corporation is taxed on its earnings as a corporation. The income does not pass through to the individual owners like it does in a proprietorship. So the corporation completes its own corporate tax return and it pays the taxes that it owes on its earnings. That's one tax. Now, if that company, and this is an if that company decides to pay dividends, which means it distributes those earnings out to our owners in the form of a dividend, then once the owners take hold of that dividend, in many cases that dividend is taxable income to the owner. So dividends, the earnings of the company is taxed in whole. Dividends are not a deduction for a company. So even if they pay out dividends, they don't get to deduct that from their taxes. They are paid on their earnings. If they decide to distribute the earnings remaining out to their owners, then those earnings can be taxed at the owner's level if the company paid the dividend. So that is a little bit of an issue, and that is a characteristic of it, but it also sometimes is considered a limitation or a downside to a corporation. Other downsides are increased fees. It costs a little bit more to maintain a corporate charter or to receive a corporate charter, and you have to file annually. Usually there is renewal fees when you file each year with the state. And then on top of that, you have a greater amount of regulation, especially if you are a public company. If you are a publicly held company, then there's a lot more regulations that you have to deal with versus a proprietorship. Many of you watching this video may be part owner of a corporation. If you currently own stock in any publicly traded corporation, you are actually an owner of the company. Some people say we're investing in, but you're actually buying ownership in. So what is unique in the accounting for a corporation? Well, first, it is the issuance of ownership rights. This is called stock, or it can be referred to as capital stock. A company incorporates in a state, only in one state. So it doesn't matter how many states you actually operate in, you only have to incorporate in one state. Okay? By filing articles of incorporation and being granted a state charter. This charter will describe the number of shares of stock the company is authorized to issue to owners. So let's discuss stock a little further. There are a few concepts we need to be familiar with when discussing stock. The first is there can be many classes of stock. You may have heard the terms common stock or preferred stock, but some refer to classes of stock as well, such as Class A or Class B. We will use the terms common and preferred in this class. Okay? So let's talk about common stock. Common stock, these stockholders have voting rights. They elect the board of directors as well as vote on actions that require approval, such as mergers and acquisitions. In addition, they have preemptive rights, meaning they have first right to purchase more shares of stock in the event the company issues additional shares. This is so the ownership is not diluted. In the event of liquidation, any remaining assets may be distributed to the common shareholders. And the other type of or class that we're going to talk about is preferred stock. And again, different companies can call this different things. It could be Class A, Class B, common, preferred. Common terms are common and preferred, but other types can exist depending on the company. I mean, there are all sorts of terms related to these types of stocks. But preferred stock, these shareholders do not have voting rights, but they do have first rights to dividends, and they have first rights to assets in the event of a liquidation. After creditors, of course. So they're on the owner's side. Remember, assets equals liabilities plus owner's equity. So your liabilities, your creditors have first claim on your assets in the event of liquidation. But when you move over to the owner's side, preferred stockholders usually have preference to assets over the common. All right. The type of stock depends on what you actually purchase. I think majority of what we know is common stock, though. So if you go out to like the New York Stock Exchange and you buy company stock, typically you're purchasing common stock, or a lot of times Class A stock. So that just depends on what you buy. You can buy preferred in some fashion or quantity, but majority of everything is common stock. Stock has one of three states. Okay, so when we're talking about a corporation, their stock, their shares of stocks can be one of three things. They can be authorized. Now, when stock is authorized, what that means is these are the number of shares we're allowed to sell. We are allowed to issue as we are allowed to issue as many shares as we are authorized in our charter. So when you complete your state charter and you receive your state charter, the number of shares that you request is what the state will approve for you to sell. If you want to sell over the number of shares authorized, then you have to file your articles requesting additional shares be authorized. So the state actually grants you the ability to authorize shares of stock. All right. So then once we actually decide to sell them, we call those issued shares. That means we have sold those shares out and they're out in the marketplace. We are allowed to issue as many shares as we want as long as we do not issue more than we are authorized. So if you're authorized a million, the most you can ever issue is a million without requesting additional authorization. All right, so that's the shares issued. And then last thing is the issued and outstanding. Now, issued and outstanding means we have issued the shares out and they're still out in the market, which means they're still controlled by the open market. They're controlled outside of the corporation. Okay, most of the times when we look at these are the shares that we have issued less any treasury shares that we've purchased or retired, but retired becomes unissued. So really, issued and outstanding, we've issued shares, we subtract any treasury shares that we have. And if you look at the second lecture for this unit, you'll see we talk about treasury stock a little bit more in depth. So it's the issued shares minus the treasury shares. Those are the shares that are issued and outstanding. Well, why is that important? Well, companies only declare dividends, which we'll talk about a little bit later, but they only declare dividends on shares that are actually outstanding. So it is important to understand that concept. Now, the last thing we need to discuss is our par value. Par value capital stock has been assigned a value by the charter. In times past, so back in the day, it's not so prevalent today, but some states still have it. But back in the past, this was considered the legal capital the company had to retain in its business to protect its creditors and shareholders. Given this legal requirement, states require companies to sell shares at par or above. So, in other words, we could not sell a share of stock for less than par, and typically that is still the case. You can get permission to sell less than par, but typically speaking, you can consider par the minimum selling price, the absolute lowest price you could accept for your stock. Now, we figured out that par has no bearing on the value of stock, and typically it's given a very low par value. So par really does not protect the shareholders, is what they found. However, even though we found that it really doesn't protect anyone, many states do still require the par. They still have those state laws on there, even though they may be outdated. They just haven't been updated for whatever reason. They're still sitting there with these par values that the state requires. So this would be considered an issue for us as an accountant. Now, if the state doesn't require a par value, the company can issue at no par, which is pretty cool. So let's talk about that. From an accounting standpoint, which is really what we're concerned with here, we're not worried about the state law so much in learning how to account for this stock. We're worried the fact that the state requires a par, so our company had to set a par. From an accounting standpoint, par value is, one, we've already said the minimum price we could sell the stock for. But when you're actually recording the transaction, when you issue stock, this is actually the value you record. You record the actual stock account for. Doesn't matter how much you sell it for, you have to record the stock account at its par value. All right, the next type we had was no par. But now, even with no par, some states still required a capital requirement, or you had to retain a certain amount of capital in that state. So what would happen is they'd have no par. The state allowed no par, but the company had to place a stated value. Now the difference is par value is set at authorization. If the state required the capital but they didn't require a par value, then what you would do is at the time of issuance, to make sure you met the state law, you would actually set a stated value. So these are no par with stated value. Well, from our standpoint, a stated value is treated just like par. In other words, that is the amount that you have to record the stock at. So just like par, that is the stock amount. That's how we have to record the stock on our books. And then last, there was just pure no par. Well, when there is absolutely no par, no stated value, then we record the stock at the actual market value. What that means is the cash we receive. So whatever amount of cash you receive, that's the amount you would actually record that stock for. All right. Enough on the background of all this stock. Let's actually look at a couple of examples just to sort of get a feel for what we would do here. So Parker Company Incorporated in North Carolina, and is authorized to issue 100,000 shares of stock in its state charter. So that's the number we're allowed to issue. The company issues 5,000 shares of $5 par value common stock for $15 per share. What would the entry be to record the issuance of stock? All right, well, we don't have a date, so I'm just going to put A there. Now, in this case, what's happening is we're issuing shares of stock. And what are we receiving? Well, we're receiving $15 per share. So in this case, we're receiving cash for our stock. So we're going to go in and we're going to put in our cash. Now, how much cash did we receive? Well, we issued 5,000 shares, and the market value, the fair value of that stock, ended up being 15. So we sold it at $15 per share. So we actually netted $75,000 on those shares. All right, now what's next? Well, we issued shares of stock and we received cash. So we debited what we got. Now we need to actually credit what we're giving out. And we are giving out, in this case, common stock. So we need to go in and hit our common stock account. And that's going to be 5,000 shares. Now remember, we said a minute ago, common stock, if it has a par value, must be carried at par. So we're going to take those 5,000 shares and we're going to times it by $5 per share. That would give us a $25,000 value for our stock. Now, as we know in accounting, all debits must equal credit, so we've got a little bit of an issue. We are out of balance by $50,000. Well, this was a problem in accounting. We're like, well, we can sell our stock for whatever amount we want to, right? Whatever the market will bear is the amount we're allowed to sell the shares for. But we have to record the stock per our GAAP at its actual par value. So what do I need to do? Well, we created a paid-in capital account. So we physically call it paid-in capital in excess of par, and this is on common stock or common shares, okay? Well, what is paid in capital? It is simply an additional paid in capital account. So when you look at the balance sheet for a corporation, you have two sections. In the stockholders' equity section, we have the actual paid in capital. The paid in capital section, that's the amount that our owners have invested into our company, comprises of the stock account, which is carried at par, and then we add to that the additional paid in capital, which is all the money that the owner paid in above the par value of the stock. So combined, if you combine those two, you see the exact amount that our owners contributed into our company. Okay? So it is just a stockholders' equity account, just like common stock. Those two go hand in hand to tell us that since the stock has a par, the owner invested a total of $75,000. All right. Now let's look at this next one. Note, if this were no par value with a stated value of $5, the entry would be exactly the same. So keep in mind, whether it's a par or a stated value doesn't matter. From an accounting standpoint, we would treat them the same. Now there is one slight difference. In our paid in capital account, we would put paid in capital in excess of stated value, okay? So that is a little bit different in that respect, but that is the only difference there, is that it would be called stated. Now in my class, if you accidentally put paid in capital in excess of par for both, I'm okay with that, but keep in mind it should be paid in capital in excess of stated. Now, I will give you another little hint. A lot of times, especially in my classes, I allow students to abbreviate. So for paid in capital, let me go up here and write this out. For paid in capital in excess of par, I actually put paid in capital in excess of par and then common. So I actually abbreviate PICIP. I know that's sort of odd, but it makes it easier to write out. So if you are in one of my classes and you want to use PICIP, please feel free to actually use PICIP there instead of having to write that out. All right, and now the last thing here. Note, what if this were no par, no stated value? The stock would look, or the stock entry would look like this. Okay, if it's no par, no stated, again, we still receive the cash of $75,000. In that case, no par, no stated value, we get to record the common stock at the same price. So we get to record the common stock at market. So that's what it would look like if it were no par, no stated. All right, so that's examples of issuing stock for cash. Now remember I said there was two classifications of stock. There was common and preferred. How would these entries look if this were preferred? Well, let me just show you one. Right here on part A, if this were preferred stock, the only difference would be instead of common, we call it preferred. All right, and that's really it. The only difference if you're issuing preferred stock over common stock in the journal entries from an accounting standpoint is one's called preferred, one's called common. Again, the problem doesn't say that, so let me revert back to the original, but I just wanted you to see that that's what it would be if it were preferred. So anytime you issue preferred stock, replace the word common with preferred, and you're good to go. So don't over think about that any. They're identical. So if you can issue common, you can issue preferred on accounting books. All right, and let's look at this last thing. Now, it is possible to issue stock for more than just cash. We always issue it for whatever we receive, and in this case, we're going to receive something a little different. So what if Parker Company issued 5,000 shares of $5 par value stock for land? The stock is actively traded on the market for $20 per share. The land is listed for sale at $120,000. Well, in that case, remember I said you debit what you received. Did we receive cash? No, we received land. So we're going to go in and we're going to hit the land account. Now, here's where it comes a little tricky. If you issue shares of stock for something other than cash, for an asset other than cash, you record the asset at its either the fair value of the asset or the fair value of the stock, whichever is the most determined. Now in this problem, we know the stock is physically trading for 20. That is a hard set value. If we were to sell these 5,000 shares, we'd get $20 per share. Now, on the flip side, we also know that the land is listed for 120. But keep in mind, list price of assets does not determine fair value. The way we would have to find the fair value of that land is to actually have the land appraised. And in this case, we don't have the appraised value. So we have to actually go with the value of the stock because that is what is more readily determined. That is a more accurate picture of value in this case. So what we would need to do to find the value of the land is to take those 5,000 shares we're issuing times the $20, the fair value of the stock. So we would actually record this land at 100 regardless of what the list price was. All right. Now, beyond that, the issuance is the same. We're going to hit our common stock account because that's what we're issuing here. It's going to be 5,000 times $5, so it's going to be a $25,000 common stock. And then again, anytime that we issue for more than our par, we put it in the paid in capital in excess of par account on common. And again, for my students, PISIP is absolutely fine to use as an abbreviation. Check with your instructor if you are looking at this from a different site, okay? So there is 75,000 going into PISIP. So hopefully this helps you understand the